whether it's the right medicine or not. But what's interesting here, Basel III was largely created to address a problem that we had in North America and Europe. And also, as Rakesh had outlined, there was increasing determination not to implement Basel III to the extent that it was originally proposed. But most of the Asian regulators are still supportive for it. So it's like almost the medicine has created for a sick man in Europe or North America, the healthy man in Asia is going to swallow it. And whether that's the right strategy remains to be seen. And one final point I make, and then I come to the potential solutions around this. I completely agree. We'll never find the right regression whether trade has collapsed first and then trade finance went down, or whether trade finance collapsed and that had an impact on trade. It's certainly both components here, but what we have seen, both from data of regulators that we worked with and many banks across the region, every bank has run down their portfolio in their non-home markets. In your home markets, you're supposed to continue to do it effectively, but in the 2008 crisis, post-Lehman, we've seen it from 3 regulators in the region, all of the foreign banks have cut it down. It's a short-term, it's a self-liquidating product, it's the easiest way to reduce the balance sheet effectively. There's one other component. When you look at a comparative statistic, the cost for freight, take the Baltic Dry as an example, in the Lehman crisis comes down effectively. And of course, you adjust that because there's lower demand, hence you reduce prices. Trade finance acts effectively in the opposite. So what happens is prices shoot up because the banks don't trust each other anymore. And what it ultimately means, yes, there's probably financing availability still out there, but at costs which are largely prohibitive, which is also to be kept in mind. And finally, one point around the market structure, which we also need to look at. Globally, 5 banks account for about 40% of the global trade finance revenues, including HSBC at the top end of the group. In Asia, that share is a little bit lower, but you then have a broad range of also European and North American second-tier institutions accounting for a large chunk of it. And many of these institutions today are deleveraging, which has an impact that we already start seeing in Asia. Now, what that means is they're advantaged by the network economies that they have, these global banks, because if you're able to handle a trade from both legs of the transaction, of course, you're more efficient in terms of the risk management solutions and so forth. And that has largely held back Asian banks towards deploying their liquidity in the market. And the other issue there is they don't have access to a lot of the US dollar liquidity, and as Rakesh mentioned, the Asian trade is largely still conducted on US dollar. And that's an interesting point, because what we see in Asia, we see a massive shortage of US dollar liquidity in the banking sector and in the corporate sector. But at the flip side of that, we see a huge amount of dollar liquidity within the central banking system, particularly take China and Japan. So one of the solutions we'll discuss in a minute is how can you deploy that liquidity, the US dollar liquidity, that sits into the central banking system, and potentially put that out into the private banking sector system. Now, the solutions that we're seeing, and I'll split it across what the global banks are doing, what the Asian domestics are doing, and what potentially the regulators and the central banks across the region could be doing. Global banks, what we're seeing, they've started some securitization transactions in order to run off certain portfolios to bring that into the institutional investor market. But typically, even despite the fact that they're global, each of these banks tends to have a relatively strong focus on certain parts of the market. So it's not a fully diversified portfolio. And what institutional investors are looking for is largely very, very broadly diversified portfolio. So what we're discussing with a few banks is to create what we call a trade facility, where you source assets from different banks and effectively make it tradable. It's almost a money market substitute type of product for institutional investors, and potentially also for corporate investors, because again, the attractiveness of trade finance is risks are very low of that product. And I think that has been demonstrated in all the data that the IIF and other institutions have been pulling together. That's happening, but it may take a little while. So can Asian banks step up now in the meantime? The problem, or the short answer to that, is probably not yet. To some extent, they lack the network. They're short of US dollar liquidity, and unless we see that switch towards more Asian currency dominated trade flows, it will be difficult for them to step up. And let's keep in mind, trade is a relatively narrow product in what I would call the broader transaction banking product that is being offered. So corporates are not just looking for the financing of their letter of credit, they have cash management requirements on top of that. Clearing settlement solutions that they need to provide, and if you're not having that broad network of clearing capabilities across multiple currencies, again it makes it difficult to really penetrate client segments which are in the mid-market and above of it. So let's now discuss what potential solutions we've, together with the Fung Global Institute, come up with, and I think we're at the starting point of that discussion, but let me flesh out 5 potential ideas that we've seen. And one is a guarantee-led type of model. What you do have in the market today is Exim banks and export credit agencies that provide direct guaranteeing on the risk of the transaction to the corporates ultimately. What you could be doing as a central bank or a regulator is to provide guarantees to banks who confirm letter of credit, basically taking the other bank's credit risk of that transaction. And again, that would ensure certain risks are being managed on a more effective basis. The problem with that solution is it typically works throughout the years, but as soon as you run into a crisis, Lehman style, it will no longer work, because these crises are liquidity crises, and in a liquidity crisis, a guarantee is not going to help you. So it's potentially a nice idea during the regular times, but not for times of crisis. The second component we discussed was around ring fencing, and you have these ring fencing discussions in the UK with a separate split of certain investment banking activities that are being ring fenced out of the core banking system. What you could think about theoretically is, say, that a certain part of the corporate deposits that any bank takes in Asia needs to be ring fenced for financing trade flows effectively. Again, that would probably require quite a bit of monitoring from the respective central bank, and it's probably not an easy to implement solution, but it's a tendency towards, say, part of what you're sourcing as the corporate deposits, you need to redeploy that into the corporate sector. The third solution we had was direct purchases, and it was a point that was made in the earlier panel much more around infrastructure finance, where the sovereign wealth funds and pension funds couldn't step up their efforts in that regard. And similarly, you could argue in the trade finance space. When you read the rationales for these sovereign wealth funds, they typically argue we're here to support the future economic growth of our country. Well, trade for almost all of the countries is core of the future. Hence, you would certainly have an argument for saying they should be financing, or at least taking their stake in financing the trade flows. And then is what we called the Smart Eltro scheme, which the name should not imply that what Europe is doing these days is not necessarily smart, but much more a point around being a rifle shot approach, if you want. So that the central bank would discount trade receivables effectively on a rather short-term basis, and again provide liquidity into the market. And the final component we came up with was an industry-led fund, where we say the banks are not going to solve it, the regulators are not going to solve it, hence let's set up something directly from the industry, a fund, and you would tax certain transactions, for example, feed up a fund that then would be able to provide liquidity in certain times of stress. So those are, in combination to what we see happening in the private banking sector, potential solutions which we believe, particularly here out in Asia, given the macroeconomic importance of trade, should probably be discussed in more detail.
Thank you, Christian. I'll move in just a moment to questions. I just want to say a few phrases based on what we've been hearing. Firstly, it's very clear that there is this central role for trade, and there are a number of initiatives that need to be taken. I think some of the questions we heard in the first session about what is the role at the national level, what is the role at the Asia level, and how does Asia find a voice globally, come very sharply into focus here. And we kicked off by talking about feedbacks. We had the question in the previous session about, is there an Asian financial architecture or a global financial architecture? Of course, everything is linked. At the same time, we need to take very specific areas and understand the specific issues and opportunities there to use that for action. And we see trade finance as a very valuable way to focus those efforts at the early stage. this links also clearly to questions around renminbi internationalization, as we talked about the US dollar liquidity. So the panel might want to come back to some of those. Before we do that, I really welcome questions from the floor, both on reactions to the importance of trade finance as an issue and the initial ideas and options we're exploring as a way to strengthen this for Asia's future development. So can I see questions in the front, please?
Thank you, panel. I think this is a very good introduction to the subject matter. I talk here as an ex-bank. I'm retired. I'm not doing anything at the moment. So certainly ROE is not what I'm concerned about. I'm just talking about how to get started in the economy around the world and getting to recession and stuck in this situation. And I think from that point of view, intuitively, we all know that one way or the other, it must do with trade back to basic again, as far as the economy is concerned. But talk to the bankers about it. You understand the practitioner bankers will not understand that, because he got other kind of pressures, and these pressures are both external and internal, in terms of the asset allocation of the bank and the liquidity of the bank, and ultimately, of course, the struggle for ROE during the bad period. And here, the trouble with trade financing is effectively the world's got rather complacent, and a lot of bankers wrongly believe, given the high concentration of the number of people that are doing trade financing. You go to the figure 40% of the total trade financing is done by 5 banks, in your case 9% of it is your bank. And I think as practitioners, we didn't have the figures down to be understood yet what we will face in terms of keeping trade financing going in our country. Because we understood what networking means. We understood networking means it's something that you want corporate banking, you can't avoid it, and it's part and parcel that you offer that kind of services to your client. Even though it was probably, I'm talking about this mainly the H's and I's, and as we go to more universal banking concept, it get even more personalized as to what's happening to those of us who got to make the final asset allocation to the bank in terms of risk management, what we had to do. And you get really down in line in terms of how senior management see these things, and they take it almost for granted. They know this is the most unprofitable part of the business as far as they're concerned. They're doing it just for waving flagship because they're doing corporate banking, and they got fed up with that. They said, look, I'm not going to compete with it. And you mentioned 5% return now. In reality, I think for a lot of us, it was never a 5% return. Basically, in order to get that kind of a client and to take them away from HSBC, take them away from the 5 banks or what have you, you're lucky to get something like 0.5% return in order to get that trade, right? And why do we do it? Relationship again. And why do we do it? Other trade-offs like currencies and currency trades, which you need to boost up your volume of content, right? So, and yet we were caught because we didn't have enough developed sort of branches internationally to draw the sort of not a mismatch situation. And during the crisis, this is the crux of the matter to me, which is effectively, I think the panel is sort of looking into the subject in deeper. Look at this question from bringing it up slightly higher from micro to macro sort of aspect about it, which is the whole complex of the whole system. By the time we get into universal banking, this question actually does intrigue, which is a new thing. But during my period, obviously, investment was not kick in yet. They were struggling with investment too. Right? Even then, we had a problem with the rating issue. And the rating issue was just not a central bank. As a stakeholder, practically, from a shareholder's point of view. The rating agency itself is the biggest corporate. And I think not enough attention is being focused on the rating agencies. Damage it to the industry, right? Because in trade financing, what do you do? Effectively, it's a question about acceptability of name.
Yeah.
Right?
Can I maybe get some reaction from the panel around this question of the attractiveness of trade finance in the broader portfolio? As the other feedback and context we take this line. Maybe, do you want to start, Andrew?
Let's go back to the policy issue, Rashid, here, because the thing that actually, I just give you a reaction. You look at trade finance as a micro subject, but actually it has massive macro implications. Yeah, and I just want to reinforce this particular point. What I realized from this was, we're looking at it the wrong way around. Now, why is it the wrong way around? Most of us talk about trade finance as if this was international trade finance. But where can you make money? The best form of trade as services is domestic trade. Not very well measured, not very well measured. Now, how do some Asian banks make money from this? Danamon Bank started in Indonesia the wet market financing, right? You station a guy in a wet market, and actually the people in the very simple, sort of fish, meat, chicken, sort of vegetable sales, daily trade, they were actually getting 30% per year interest rates, but finance on a daily basis. Right? Now, if you then think through this concept, you realize that most of that trade finance in a lot of domestic trade has never been measured, has never been properly financed, and the poor SME is struggling to get that, and that's why the Wenzhou financing of this world is willing to pay the massive financing. So, then how do you integrate that domestic trade with the international trade is the game for banks, how to make money from this, from that network effect. And from the policymaker, how to make that trade flow all the way from domestic to international as a profit-making, finance to support the real sector economy issue. And frankly speaking, as somebody who's worked in the national system, this is the area where policymakers have paid least attention to, because that is where the job creation is, and the domestic trade creation really comes from. And I think, whilst people are going to subsidize, SMEs, they haven't figured out they can actually do this very effectively through, sort of trade finance and trade aspects. Sorry.
Yeah. And as a sequel to that, I think that there's further to that. I think even at a macro level, if you talk about the economy a little bit, you look at Asia, for example, which is what we're talking about today, in terms of 60% of the future trade. And I think Asia is a little more complex in terms of how it works. And for a large extent, the one we're competing with are the multinational guys who squeeze you to the wall in order to get that trade. So who do we want to finance it? We will force down the line to finance the small boys who are SME in a way. But it is also, look, in a recession, who do you think that hit most effectively as small boys in terms of exports, which is certainly again, right? And how do you stick your neck out and take that risk? If somebody else on the top level, the regulated development is in the house and give us a guarantee of what have you. Because this guy hasn't got enough of credibility now. For us, been financing at rate 0.5% or 1%, right? And if that squeeze goes on and on and on, it gets tighter and tighter. And this is something that you've got to get out of in order to get the trade flowing.
Yeah.
I think that's really my main point.
Could I maybe ask Rakesh to come in on this question around, as HSBC, which is often in a different position to some of the local banks, then maybe Christian and Dr. Rhee would like to share some perspectives on how other banks are looking at this. Some of them maybe don't have the strength of positions that HSBC has in the market.
Yeah, I think that this is an interesting point about the attractiveness of trade finance as a portfolio within a bank. I think I definitely speak for HSBC. I think Andrew said that most of the banks have started as trade banks, and certainly we started 150 years ago as a trade bank. And if you see the recent commentary even from our good CEO who was here earlier, that trade is our heritage product, and we will make sure that it remains center stage for us. I think we look at it in terms of our portfolio products from three angles. The first is that it is a very critical part of the entire relationship with our customers. And when I say about relationship, it just doesn't mean the Walmart. I think we are equally comfortable because of our heritage, being in Asia for 150 years or so, with the SME in Bangladesh or Vietnam or in Egypt or in Mexico. We are a lot more comfortable than most of the other multinational banks. So we see that as a very critical part of the relationship. The second attractiveness of trade finance is the lack of volatility. So I think a lot of the other products we talk about might have a much higher ROE, but the kind of volatility we see in trade finance is significantly less. And that adds to the attractiveness for it as a very key portfolio product. The third aspect is that in terms of pure profitability, I think we see that as attractive. The kind of returns we've been able to get in terms of the entire cross-selling piece is attractive. So I wouldn't rush to say that it is not viewed as profitable or attractive within the bank's portfolio. I think at multiple levels we see the attractiveness. I think if I look at it from the industry viewpoint, more and more banks, with the experience of the last 5 years, are attracted by the flow products and the transaction banking products, whether it is cash management or trade, are very critical parts of the flow product, and that's adding to the attractiveness. So we do see more banks entering, more from the regional and local players than from the global players. And that is where the entire debate about Basel comes into play, because if you're going to make it very difficult for banks to come into the space, you will have a problem in terms of attractiveness of this particular field.
Just a few points to add. I think trade finance historically has also been a good entry product into a relationship, because by definition it's an area where you can attack the domestic banks, because apart from the example that Andrew had, any type of international trade, it's easy for a global bank to say, well, we're much better positioned to handle your trade flows because we have a global network. And we've seen that throughout Europe, where in the last decade, a number of the banks, as part of the common market, have moved into new markets. They took trade as a lead product, and some of the leading Asian banks have been doing effectively the same. So it is a good product to go into a relationship. And I think on the economic side, certainly what we've seen, the gap has narrowed between trade and other products on the wholesale banking side. Certainly pre-Lehman on the fixed income products, most of the banks at the top end were making 25–30% of ROE. That's difficult to achieve these days because the capital requirements have increased quite a bit. So we've just looked through the real ROE based on the data that we have from the 10 leading global investment banks. And when you do that, you basically see that also on the fixed income side, given it's a massive scale business, certainly it's what we call that flow monster approach, that you need flow in the core products. And 5 to 6 banks have that effectively, but the economics, only about half of them have attractive economics north of 15% ROE, others haven't. And in Asia, on the equity side, just to complement the loop, it's a relatively unattractive business from an ROE side. The point is exactly, if you're only just able to offer a narrow trade product, you're being squeezed out of that. And I think the only final point I'd like to make here is, when we discuss that Basel III topics, there's certainly the temptation to say, well, anything trade-related is good and anything derivatives-related is bad. I think we need to clearly make the distinction that a lot of the flow derivatives are as important as trade finance is ultimately, because if US dollar denominated trade is the majority of what we see in Asia, you need an FX hedge attached to that. You need flow swaps, interest rate swaps, in order to hedge certain macroeconomic risks that you have in your balance sheet. So just to put that into perspective, and once you have that, it allows you to achieve a certain ROE, but the point that Andrew made at the beginning, unless we have in Asia a situation where trade, and I would, let's say, the broader corporate and transaction banking products creates a return which is more attractive than other parts of the business, you're not going to bring Asian banks to primarily invest in that area.
Thank you. Question in the front here.
Thanks very much. I think Andrew has made a very persuasive case for the choice of this topic. And it really is absolutely profoundly important in supporting the real sector. And of course, from my perspective, trade finance is Islamic finance because it's there's always an underlying transaction, either in the form of the movement of goods or the provision of a service. Now, I want to go to the Basel III issue, really, because I do realize that there are two distinct issues. One, of course, is the instability in a financial system that could arise by barriers to trade finance. But Basel III seems to me to be a little bit different. And I want to ask the panel whether, in fact, there are flexibility provisions built into Basel III which would allow us to weather some of these difficulties. For example, I remember in November that the chairman of Basel III, the Basel Committee, mentioned that going forward, that phrase has just cropped up again, the Basel III will allow a more flexible use of its core equity requirements for trade finance. In particular, they will no longer require that, for example, Rakesh has mentioned the case of shipment of goods from Bangladesh. You won't have to use the sovereign credit rating of Bangladesh to assess that transaction. You'll be allowed to use your own internal rating methodology of the risk. Now, I haven't actually followed, I follow Basel III very closely, but this is the one area where I haven't followed enough. So I'm not sure where we stand. Has Basel III actually gone forward and allowed that flexibility? And if it has, does this help us to address this vitally important issue?
Someone would like to take that? Rakesh, may.
I think that you're absolutely right. I think the BCBS did make that statement that they will allow the maturity floor waivers to go below the sovereign ceiling. So they allowed that particular flexibility. I think, but the number of issues which are going to restrict trade finance under the new Basel regime are actually much more wider. So there's on leverage ratio, on liquidity ratio, on asset value correlation, on maturity floor waivers for all the products. It's a very big issue, and all those four, Basel is treating it very clearly as one bucket. All products will be treated the same, and no differentiation will be allowed for trade finance. And I think from where Basel comes from is that if you allow for one product, then other products will ask for it as well. So there's no specificity for trade finance products. Having said that, as I mentioned, just I think it was about 4 weeks back, that European Parliament and European Commission have agreed to all the representations on these four issues which I just raised. And therefore, it's very likely that the European financial institutions will not be subject to it. But the global Basel system is not yet accepting them. So there's a real risk that if Asia is following Basel III and Europe is following its own what we call CRD4 regulations, then there will be a regulatory arbitrage and the Asian financial institutions will be at a loss.
Dr.
Now, just I think one thing which I'm missing is about the recently they proposed global CP regulation. And actually, most trade financing in Asia is provided by the global CP. And in global CP regulation, one of the proposals was to impose the capital cost based on the extent of cross-border transaction. So in some sense, if you have a similar businesses, but if you have more cross-country transactions such as trade financing, you will be penalized. So I think these are examples that they have to take care of.
Just one final point, maybe. I think you're right with your example on the sovereign rating side. Basel has exempted them. But the key issue that we're having on Basel still today is the leverage ratio. And that's a new ratio where Basel said, given trade is primarily an off-balance sheet product, we have 100% credit conversion factor effectively. And that's the core of the problem. So there's always been discussion, has been increased from 20 to 100%. No, for the core capital requirements, it's still at 20%. But in addition to measure the leverage ratio, 100% factor is applied. And there's been a lot of data submitted to the Basel Committee that said trade is a low-risk product. But Basel then said, well, that's good and nice, but that's not what we're trying to address with the leverage ratio, because the leverage ratio is in addition to all these fine-tuning that we have, a very, very simple ratio. We add up everything on a fair and systematic basis, and that's it. Now, whether that is right or not, in the line also that Rakesh outlined it, that you may want to have some advantages for trade products and so forth, but that's the rationale that lies behind the leverage ratio, and they haven't addressed this, and they're not willing, at least as I see it, to concede on that.
I think the problem might be just conceptual one that Western economies have forgotten about trade finance. And we have a different approach to trade finance, but it's so important to us.
Yeah, it's very clear from our study that, for example, Middle East trade finance will be very, very much also affected by the Basel III rules. But the issue really boils down to, and this is a little bit technical, but I'll get back to the macro side again. The Basel III rules, are the classic problem of one size for all. And once you get down to the